Hey guys, welcome to Finance, Business and Investing. Many people want to know how to invest in stocks and what the best way is for beginners in 2023. In my honest opinion, I think that any stock can be a good investment if you buy it at the right price. But you need to know how to value a stock to know what a good price is. In this episode, we'll show you the top 3 ways to do that. How to price a stock. Number 3, price to book. The first way to figure out how much your stock is worth is to look at the company's book value. What we want is a company that is cheaper to buy on the stock market than to start over from scratch. That's what we were wondering. It's the same in real estate investing, where the best investment is one you can buy for less than what it would cost to replace it. Now we want a company where is book value, and this means that all assets minus all its liabilities or all the possessions minus all the debts is bigger than the current market price of the company on the stock market. To get the price to book ratio, we divide the market price by the book value. Now, this is how Warren Buffett used to invest in the past. He was looking for a company that still had some juice left in its cigars and a puff left in its lungs. With this measure of value, you can be sure to buy a company at a great price. If the price to book ratio drops below 1, the disadvantage is the only thing you look at is the company's balance sheet. This might be useful for a real estate company or other specific situations, but you usually buy a company because of what it does. This is where this valuation metric falls short, because it doesn't tell you anything about how profitable the company's operations are. You might buy the assets at a great price, but you don't know if the current team or processes are using those assets in a profitable way, so it's best to use this metric along with the next metric, number 2, price to earnings. By looking by price to earnings, you're essentially looking at the time that it takes you to get back your investments. You divide the price on the market by how much money the company makes. Depending on the type of company you're buying, if the price to earnings ratio is below 10, you're usually getting a good price because of a 10% return. If the ratio drops to 5, you're getting the company at a great price, because of the 20% return. On the stock market, we usually get a return of 7 to 12% per year. To put that in perspective, if you keep reinvesting your profits or money and get a 20% return, it doubles in 3.6 years. When you use the price to earnings ratio, you can get a good idea of what a company is doing. But it has some problems as well. For example, a company that is investing in its growth and expansion will make less money. But this will be worth it in the long run. On the other hand, if a company has a very profitable due to one-time event or books a profit that doesn't show up in cash flow, this is also an error. You might have a company that looks like it has a P of 100, but if it grows by 100% every year, that might be the right market price for the company. More on that in a minute. On the other hand, if the P ratio is low but the company is going out of business and doesn't seem to have a bright future, it might be okay for the P ratio to be low. When using these ratios, it's most important to know about the company so you can figure out what the numbers mean. Now, one way to use the P ratio to account for a company's growth is to divide the P ratio by the company's growth. Imagine you have a company with a price to earnings ratio of 20. In theory, that means you won't get your money back for 20 years, so it's not a great investment. However, if the company's earnings grow by 25% each year, they will double in 3 years, bringing your P ratio down to 10. If the company can keep doing that for another 3 years, it will drop to 5. This is what they call the PEG ratio, which stands for price to earnings growth ratio. Now, before we get to number 1, I'd like to add something extra. Bonus dividend yield. Now I believe in investing for cash flow because that cash flow can be used to pay for not only your living expenses but also high-risk investments that might be a big home run or a big fail. These are your moonshot investments. Investing for dividends is one way to get cash flow from your investments. You can look at the dividend yields to find those dividends. Usually, a company with a dividend yield of more than 5% is a good dividend investment. However, you should also look at the payout ratio of that company. If the payout ratio is above 50%, it's likely that the earnings or profits are being kept in the company and not given to shareholders aren't enough to fund future growth. Now, an interesting way that you can value stock is by looking, is the dividend yield higher than the company's P/E ratio? If so, and if the company's future isn't too bad compared to the economy as a whole, you might have a great chance to buy it. Now comes the number one, price to cash flow ratio. I always think you need to look at the cash flow of the company. Ask Grant Cardone, and he'll tell you that cash flow is king. I honestly think that if you want to figure out how much a company is worth, you need to look at its cash flow. Now, what's interesting about cash flow is that you divide the price of the company by its cash flow, and if you get a value of 5 or less, you know that the company is worth less than 5 times its price. In terms of money, that means it will pay for itself in 5 years. If the company has nice growth prospects, then you might go up to 7. If your business is doing well and staying stable, you should look at the valuation twice or triple the cash flow, especially operational cash flow that comes directly from the company's activities. Doesn't lie. If the company doesn't have great growth prospects, this cash flow could be given back to shareholders in the form of a dividend or used to fund new investments or acquisitions that will help the company grow in the future. So, guys, to sum up this video, we'll first look at the price to book ratio and then the price to earnings ratio. You could look at the dividend yield, but I think price to cash flow is the best way to get a clear picture of how the company is doing. But if you can buy the company outright, you can look at the books and see where you can make more money or cut costs. This changes the investment thesis completely, so thank you for watching and I'll see you next time.